Welcome to Illuminati Silver. We tell the truth about silver. Today is Sunday the 30th of May 2021. And although we're talking about the euro, we are comparing it with the US dollar and suggesting that it's far too early to call the US dollar collapse anytime soon. So let's take a look as to why we say this. Now, yesterday, we published two videos. Our normal weekly gold and silver update for the week ending the 28th of May, and a second video, Will Biden's spending plans destroy the US dollar and propel gold and silver prices? And we've placed links to both of these below. Now, in the latter video, we took a brief look from a BBC report of President Biden's plans, which could force public spending to exceed GDP at levels last seen during World War II. And we discussed the potential ramifications and asked whether the US dollar was destined for a major fall, if not a collapse, and how this would certainly benefit gold and silver prices. However, a report by Bloomberg yesterday seems to suggest that other major governments against whose currencies the US dollar is compared are also operating via a very loose monetary policy platform, so much so that the US dollar could arguably strengthen against its counterparts, or at the very least against the euro. You see, this is why economics is such an interesting, fascinating, and sometimes unpredictable subject. And we must always caution ourselves against making predictions in a vacuum. Let's take a look at the Bloomberg article. Now, I have to admit it is 6 minutes long, so prepare yourself. And we shall then comment thereafter that there are some very interesting facts in this article. So if you can last 6 minutes, then do so. If you can't, move forward 6 minutes and listen to our conclusion. So let's take a look. Bloomberg article dated May 29th, 2021. European Central Bank doves SAR Euro rally with pushback against tapering bets. The euro's charge toward a 3-year high is stumbling as the European Central Bank quashes expectations that it's anywhere near paring back emergency stimulus. The ECB is increasingly expected by economists and investors to extend its elevated pace of emergency bond buying at a June meeting, even as the continent's vaccination program surges forward and the economy rebounds. That's putting a damper on prospects for further gains in the common currency, which has risen above 4% against the dollar from a trough in March. Policymakers, including Executive Board member Fabio Panetta, have signalled a willingness to shrug off near-term inflationary spikes and keep policy loose for the time being. On the other side of the Atlantic, counterparts at the Federal Reserve appear to have made peace with the need to eventually wind down their bond buying. For a significant rise in the euro, I suspect we'll need to see some hawkish noises from the ECB, said Mike Riddell, portfolio manager at Alliance Global Investors, but tapering aggressively puts the stability of the Eurozone bond market at risk, and rate hikes may never happen at all. Global central banks are quietly starting to tiptoe away from the emergency monetary settings put in place during the coronavirus crisis, and markets are reflecting slowing asset purchases and rate hike expectations accordingly. The ECB, which has struggled for years with lackluster inflation, looks increasingly set to lag the pack, while the Fed could be next in line to deliver a hawkish surprise. Traders are growing jittery at any hint of policy shifts. The pound spiked on Thursday after Bank of England policymaker Gert-Jan Vlieg detailed several scenarios for the UK economy, including one where rates rise early next year if the labour market recovers smoothly. Also this week, South Korea's central bank governor Lee Yul signalled a shift when he said officials are preparing for an orderly exit from record low interest rates at some point as the economy recovers. Canada and New Zealand have also flagged such moves, while Federal Reserve officials have been steadily shifting their tone. Vice Chair Richard Clarida said he and his colleagues may be able to start discussing the timing for scaling back the Fed's bond buying program at upcoming policy meetings. Randall Quarles, the central bank's vice chairman for supervision, noted that risks to inflation are skewed to the upside in the medium term, in part due to fiscal policy. The diverging signals out of Washington and Frankfurt are prompting strategists from Rabobank and Crédit Agricole SA to brace for the euro to decline by as much as 3% from current levels against the greenback. Options markets show clashing signs. Risk reversals, a barometer of market positioning and sentiment, point to investor optimism on the euro. Implied volatility shows low expectations for the ECB's next meeting in June. While alliances riddle moved from a short euro position to neutral as the continent got its vaccine push on track, he says there's the little prospect of fresh impetus coming from the ECB, and faster inflation in the bloc is unlikely to last beyond this year. The Fed, meanwhile, could bring up tapering at its Jackson Hole symposium in August, according to Jane Foley, Rabobank's London-based head of foreign exchange strategy. That may trigger a dip to 1.18 against the dollar for the euro, she said. The currency closed at 121.88 on Friday. A drop like that could wrong-foot investors. Asset managers' net long positions on the euro climbed this month to the highest since at least 2006, according to CFTC data. ECB officials fear a stronger euro could harm the still fragile European recovery and say they're keeping an eye on the currency. Wage pressures are weaker in the Eurozone and the recovery isn't as broad-based as in the United States, according to Jonathan Peterson, market economist at Capital Economics, factors which will likely weigh on the common currency. At the same time, bond markets are projecting European normalization, with yields expected to turn positive as the continent proceeds with vaccines and reopening. Most of the increases in German borrowing costs reflect a pickup in domestic demand and the expectation it will continue, according to Bloomberg Economics. Growth estimates from economists surveyed by Bloomberg show more room for upside in the Eurozone compared with the United States. And some analysts, including those at Deutsche Bank, Citigroup and Bloomberg Intelligence, still see the euro reaching $1.25 or higher in the coming months. George Saravelos, global head of FX research at Deutsche Bank, predicts further upside if the region's data continues to strengthen. A Fed announcement on tapering might not be interpreted as a hawkish signal, he said. Even so, the rise of coronavirus variants remain a threat to the region's economy, and history shows the ECB proceeds more cautiously than the Fed. When you look at expectations in the United States and expectations in the euro area, we're not on the same page, ECB President Christine Lagarde said in April. It would clearly predicate that we will not operate in tandem with the Fed. I think that's very much a given. It's not me looking into a crystal ball. Okay, now we have in the past often scorned those who've been predicting the imminent collapse of the US dollar, some of whom have been doing it for decades, let alone years. The reason being that we scorn them is that those individuals clearly do not understand economics in a global context. They seem to assume money printing equals bad, dollar price collapses, end of dollar. Well, over a period of time, generations, that may very well happen. But the imminent demise? We have to, you see, bear in mind that the US dollar value rises or falls as well in comparison with other currencies, from which are bought goods and to which are sold goods by the United States. So we could indeed have a situation whereas a country like the US may undercut its own currency strength due to loose monetary policy and a fiscal policy of largesse spending. But if other major countries are doing the same, and potentially proportionately even more, then the dollar could still end up the best of a bad bunch. And when a global economic collapse occurs, it could still be the last currency standing, or one of them. We should never ever forget that point, or certainly not while the US dollar remains the world's reserve currency. Cannot underestimate the importance of that. Now, that said, of course, we've all seen that purchasing power over time diminishes, which is why gold and often, but not always, silver act as a strong hedge against inflation caused by currency devaluation. But do not pin your hopes and desires on a dollar crash, or at least not until we've seen other currencies fall first. Now, taking this into context, though, we still maintain that there are strong tailwinds for gold and silver moving forward, because we can see a gradual devaluation of the dollar over time, but certainly in terms of purchasing power. And at the very least, until the Fed does begin to raise rates, which frankly we cannot see occurring in the early part of 2022, as the article suggests. That's our take on the situation. Of course, things can change over time, and we don't wish to underestimate the importance either of cryptocurrencies, or perhaps more importantly, the blockchain platform upon which many are based. We are certainly moving into an era of digital currency. And so when we say the dollar collapsing, there may not be any such thing as a paper dollar in the years ahead, but there will most certainly be a replacement for it. The question and the battle at the moment is, will that replacement be controlled by individual governments, or perhaps by unknown people operating from the dark web? What do you think? Do share your thoughts. Meanwhile, thank you so much for listening. If you haven't already done so, please subscribe to our channel, not forgetting to press the bell sign so you're notified of our videos as and when they are published. Disclaimer. Illuminati silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.